Hello everybody and welcome to our practice exercise for the double declining balance depreciation method. With this video we're going to be talking about specifically the double declining balance method and how to calculate it, how to prepare depreciation schedules under three different scenarios. What I'll mention here is that in a separate video we're covering the other different methods, straight line, units of production, and even the sum of the year's digits methods. They'll all have their own video. And furthermore, we'll cover the disposal of the assets. For example, gains and losses on the sale of the asset. We'll cover those in their own video as well. So this video is specific for the double declining balance and the actual depreciation calculations. So if we take a look at this scenario, it says Lenny's Widget Factory purchased a machine costing $257,500 with an expected life of 5 years and an estimated $20,000 salvage value. The machine was placed into service on January 1st, so the beginning of the year. When this asset was purchased, it was expected to produce only 475,000 units, and the actual production by year was as follows. And then of course we go into the detail about the years. The one thing I want to mention here is that this data, depending on the problem you're dealing with, this data may be included, but it's only going to be needed for the units of production method. It's not needed for straight line or double declining balance. So we can ignore that, but there is one piece I want to mention here. If you look at year 3, it said, hey, during year 3, they did not produce any units because they temporarily switched over to produce other products, probably with other machinery. Under both the straight line and double declining balance methods, that doesn't really matter. We're still going to take our depreciation for that year, even though we may not have used the equipment. If it was a permanent retirement and we were done with it by year 3, that's a different story, but that's not the case because we bring back and start producing in year 4 and 5. So year 3, the fact that it didn't produce anything does not matter for our straight line or double declining balance method. So we want to prepare the depreciation schedule using double declining balance method. And what I've done here is create a depreciation schedule that gives you a little bit more information than you might necessarily need. I'm trying to keep these consistent between the straight line, double declining balance, and the units of production methods. So it gives you a little bit more information, but this is handy. For double declining balance, having some of this information is pretty important. So we have 5 different rows for the different years, and we have a few terms to go through here. Depreciable cost. This is important for straight line and units of production, but it is not really important at all. It's not used for double declining balance. The depreciable cost, what that term means is it's the amount of depreciation, the amount of cost you want to depreciate throughout the asset's life. So it's basically your historical cost minus the salvage value. So in this case, it's $257,500 minus $20,000, and it's going to be the same every year. But again, I want to stress for double declining balance, it's really kind of irrelevant data. I put it in here just to show the distinction between the two methods, but it's not really needed for the double declining balance method. Instead, what we're going to use is this beginning net book value. And double declining balance, that method is a little bit unusual compared to all of the rest in that we start our depreciation using the full cost, the $257,500, rather than the depreciable cost. So our beginning net book value is indeed historical cost. Net book value, that term means historical cost minus the accumulated depreciation up to that point. In this case, at the beginning of year 1, we haven't taken any depreciation, so it's just the full historical cost. So that will change year after year, and we'll go through that in just a bit. The depreciation percentage. This becomes important for double declining balance method, but what we're doing here, the rate is going to be double the straight line rate. That's where the double declining balance comes into play, that term. So what we would do, if you recall from the straight line method calculation, we took 1 divided by the number of years in the asset's life, 5 years, 1 as in 100%. We're trying to figure out what percentage of this asset do we depreciate every year. So I'm just going to hit enter for a second. For straight line, it would have been 20%, and it would be 20% every single year, so that over 5 years we get 100%. But for the double declining balance method, we're going to take that rate and we're going to double it. So I'm multiplying it by 2 to give us 40%. Now that is actually going to be the exact same every year. The 40% rate stays the same every year. The dollar amount it relates to will differ because obviously if you add up 40% over 5 years, you get 200%, which makes sense. It's double the straight line rate, which added up to 100%. So if we double it, it's going to be 200%. But obviously we don't want to depreciate 200% of our cost. That makes no sense. So that's where the declining balance portion of the name comes into play. We now know where double comes into play. It's double the straight line rate. The declining balance that we're talking about is the beginning net book value. Every year that's going to be a declining balance because we're depreciating more and more of the asset's cost. So let's do year 1. The depreciation expense dollar amount is simply going to be that year's beginning net book value multiplied by that doubled rate, that 40%. So that means in year 1, right off the bat, we're going to calculate $257,500 or multiplied by 40%. We're going to use $103,000 out of that $257,500. You know, if it's 40%, it's fairly close to half of the cost right off the bat. Year 1, of course, our accumulated depreciation is just that 1 year's depreciation. So at the end of year 1, our ending net book value is the $257,500 minus that year's $103,000. So we're down to $154,500 that we have left for the ending net book value. That carries over to become next year, year 2's beginning net book value. And we're going to go through the same process again. Again, the double declining balance means we're taking the declining balance each year, the beginning net book value, multiplied by that 40%. And now for year 2, that adds to our accumulated depreciation. Now we're up to $164,800 of accumulated depreciation. But at the same time, our net book value is dropping by that year's depreciation. Now it's $61,800 less. And by the way, just as a quick check over to the right, if you add up any given year's ending net book value and its accumulated depreciation, you have to equal the cost. So if we do it now, if we add these two together, it's $257,500 each year. So it's the same amount. It's always going to be that way. It's just you're moving more and more cost out of net book value and into accumulated depreciation. For year 3, we're going to bring over that ending net book value from year 2. We're going to multiply it by 40%. And now we're down to a smaller number. Every year we'll get decreasingly smaller. $37,080, but our accumulated depreciation is increased by that amount. It's accumulating more and more depreciation. Our net book value at the same time is dropping by that amount. We start the year again. And I'll reference that cell just to keep us on track. So now that year's ending net book value multiplied by 40% gives us $22,248. Oops, we add that year's depreciation expense, so now the accumulated depreciation is higher, and we subtract it from the ending net book value. So that gets carried over. Now we have $33,372 of net book value at the beginning of the year. So if we multiply it by 40%, that tells us we are going to take $13,349 of depreciation out of there. Now this is kind of a sweet spot. It shows us something without making it too crazy. So what happened here was the 40% calculation that we took brought us down to not quite the $20,000 salvage value, but very close. It brought us down to $20,023. So what I want to stress here is that the reason this happens, it could go more, it could go less, it could be close like it is in this situation. But in this case, we started depreciating the entire cost. We didn't depreciate we didn't use the $237,500. We didn't multiply the depreciable cost by that percentage. Instead, we used the full cost. So there was no guarantee that we were going to end up at the net book value or at the salvage value that we expected. Under straight line, we take that cost out right off the bat so that we guarantee that we're going to end up right at the straight line value. Under double declining balance, we didn't subtract that out, so it could, depending on the number of years and what the salvage value is, it could have very well ended up below our salvage value. I mean, we could switch this problem around and say, let's assume our estimated salvage value was $25,000 instead. In fact, let's do that. Let's take a look at this scenario, understand that it just so happened that we came very close to hitting the salvage value. Now, before I switch it, I want to mention that the fact that we didn't go down to the salvage value doesn't necessarily mean anything. We could adjust our depreciation expense for that last year to exactly push us to the ending net book value of $20,000, which is where we want to be. Generally, that's what textbook problems will tell you to do. That's what your instructor will tell you to do. They'll say your last year should exactly be the salvage value. Get to it any way you need to. If we wanted to do that, we'd say, hey, last year we ended up with $33,372. We want to be at $20,000 this year. So in that case, you'd have to override your calculation and exactly take $13,372. That was the amount of book value over and above the $20,000 cost. And notice how that exactly brings you down to $20,000. That's how most problems would tell you to do it. Now, sometimes that'll mean add in a little bit more depreciation expense. Other times it'll mean add in less depreciation expense. In other words, change the amount of depreciation expense you're recording. For example, let's take one situation. Let's say now that this actually had a $15,000 salvage value instead. So let's assume that instead of $20,000, let's assume this was a $25,000 salvage value. So I'm going to put back the equation here. And in this case, the full calculation took us down to $20,023. But if this really had a $25,000 salvage value, we'd basically be saying, hey, we took too much depreciation because it put us below the $25,000. So in that situation, you'd have to adjust your depreciation expense to be less. You don't want to use your normal calculation of that situation. You would have it only be $33,372 minus $25,000 to get you exactly to $25,000. Because that is the end goal. That final net book value can never drop below salvage value. Now let's take it the other way. Let's assume this was a $10,000 or $15,000 salvage value. So let me go back to our original data set. the calculation would have put us to $20,023. But let's say it was a $15,000 salvage value. We would want to get down to $15,000. So in that situation, you take 33,372 minus 15,000, and your depreciation expense would be a little bit higher that year in order to get you down to that level. So that is the goal with double declining balance. You want to end up with the salvage value. You won't automatically do it. It was somewhat coincidental that we even got close the first time. Now, you might also have a situation, by the way, where, let's say, year 4 brings you right to where you want to be. We can make this problem happen. Let's say that our salvage value was $35,000. Year 4 already puts us below that. So in that situation, we would have to adjust year 4 to whatever amount we need to just hit 35,000. And in that situation, year 5 wouldn't have anything because any additional dollars we took would push us below salvage value. So it's about two things. How many years are in this asset's life? That determines your percentage. It mathematically determines when you might be likely to go above or below the book value. But perhaps more importantly is just the salvage value itself. What is it? Because through our different scenarios, I changed it. I went from 20 to 15 to 25 and now up to 35. And you can see we hit the where we wanted to be in different years. So the key thing to remember is it doesn't matter what year it is, your final year has to be exactly at the salvage value. And if you hit the salvage value before that final year, you have to adjust whatever that year was. And then the year after that, you're going to have 0. So that is how to handle the double declining balance method when it has a full life. I wanted to talk about a similar scenario. Well, you know what? Before I do that, let me go back to our original data set where we put it to 20,023. Of course, we would have adjusted that last year. But let's take a look at the scenario where we have a shorter life. And by shorter life, I mean that we expected it to last 5 years, and during year 4, it produced some equipment, produced some units, but then at the end of year 4, unexpectedly, we decided to get rid of the asset. We didn't have any information ahead of time that we were going to do that. If we did, we could have revised depreciation in earlier years, but since we just now found out about it, we're going to have to record the depreciation to take that into consideration. So what I want to do here is I'm going to copy this information over. Really everything we did before. I'm just going to copy it over. But the difference here is that we don't have anything at the end of year 4, or we don't have anything in year 5. So there's nothing to record for depreciation expense. It's going to be gone. What'll happen is we basically end the depreciation right here in this situation, and then when we sell the asset, we're going to have a gain or loss depending on how much we sell the asset for. If we sell the asset for $40,000, we're going to have a gain. If we sell it for $30,000, which is less than this ending net book value, we're going to have a loss. So that's the situation here. It's a little bit different than the situation earlier where it was the full life, but we just didn't quite end up hitting the salvage value. In this scenario where we've unexpectedly shortened the life, we'll stop the depreciation at whatever its normal calculation would have been, assuming it did not go below salvage value, of course, and then we're going to have a sale to record right after it. So let's take a look at the longer life scenario. Now, in this case, we found out unexpectedly at the end of year 5 that, hey, we're not disposing of this asset right away. Instead, we're going to keep using it for another year. So what would happen in this situation is your first 5 years would be identical. Keep in mind, this assumes that we did not know about this until the end of year 5. Had we known about this earlier on, we would have revised our depreciation going forward and we are going to have a video to cover that topic of revised depreciation estimates. We prefer to adjust it and spread the revised cost out across all years, but if we don't find out about it until it's too late, until those years have passed, we can only handle it prospectively. So in this situation, during year 6, or during year 5, at the end of year 5, we decided, hey, we're going to use this another year. So during year 6, let's assume that the salvage value remained at $20,000. Before, when we were at the end of year 5, I said we need to take $23 additional of depreciation expense to get our salvage value down to $20,000. Now we don't need to do that because we still have a year left, unexpectedly. So in this situation, what we end up doing is just taking that remaining $23 of depreciation expense for that year to get us down to exactly the $20,000 salvage value that we wanted to be at. So it's just $23 just to get us there, because again, at the end of the asset's life, regardless of what that life ends up being, we want to be at the salvage value. You might have some situations where, again, we already had to adjust year 5. Let's say we had to adjust it down. We couldn't take the full $13,000 of depreciation. Maybe our salvage value was $25,000, so we couldn't have taken that full amount. In that situation, similar to what we talked about before, year 6 would remain at 0 because we have nothing left to depreciate. If we've already hit the salvage value in an earlier year, we can't go any further. The other scenario that could happen in this case, though, is that, I said assume the salvage value estimate was unaffected. What is more likely to happen is that the salvage value will either go away completely because we're using this for an extra year, or it might be lower. Now that's not going to be worth as much to scrap because we're using it for another year. So if that's the case, again, your end goal, regardless of what that salvage value ends up being in this final year, you want to take just enough depreciation to get you down to that new salvage value. So that's how we would handle this scenario. Hopefully this has helped to clarify how to handle the various scenarios that could come up under double declining balance depreciation. As you can see, it's an accelerated method, which basically means that you have much more of your depreciation up front, and then it drops off quite a bit at the end, because regardless of which method you use, you're only going to take enough depreciation to get down to your salvage value, which basically means, I said that informational column over here, the depreciable cost, that is ultimately what depreciation you're going to take in total across all years. So hopefully that helps to clarify this. We will have other videos covering the other methods, the gains and losses, the partial year depreciation, change in depreciation estimates. All those different things will be covered in separate videos. So thank you for your time, and I look forward to talking to you in the next video. Have a good one.